There is a very quiet form sitting inside the property tax system that many senior homeowners never hear about. That is the part that bothers me. Not because the form is complicated in principle, not because the benefit is imaginary, not because the law does not allow it. The disturbing part is that the benefit exists, millions of people qualify for it. And yet most of the people who could use it never file. They keep paying year after year, bill after bill. Not because they are irresponsible, not because they failed to work hard, not because they are trying to avoid anything they owe. In many cases, they are the most responsible people in the system. They bought a home, they paid the mortgage, they paid taxes on time, they followed the rules, they did what society told them to do, and then at the point in life when cash flow matters more than almost anything, they continue overpaying because nobody told them that one form could reduce the bill. This is how a system can be technically legal and still feel deeply unfair. The average senior homeowner paid more than $4,000 in property taxes last year. For many of them, that bill was higher than it needed to be under the laws of their own state or county. The problem was not eligibility. The problem was information. That is one of the most important lessons about money and government programs. A benefit that is not automatic is often a benefit most people never receive. The law may say you are entitled to relief. But if the system requires you to find the form, choose the correct version, attach the correct documents, meet the correct deadline, and submit it to the correct office. Then the real barrier is not the law. The real barrier is friction. Friction keeps money inside the system. And when people are older, tired, cautious, and already overwhelmed by taxes, healthcare, insurance, inflation, and paperwork, friction becomes extremely powerful. That is why the numbers are so extreme. The ARP Foundation has reported that millions of older adults qualify for property tax relief, yet only a small percentage ever apply. In the source, the number is 9.3 million older adults who qualify, while only about 8% have filed. That means the other 92% are potentially paying more than necessary every year. This is not a small leak, this is a national pattern, and it reveals something important about how financial systems actually work. Money does not always go to the people legally entitled to it. Money often goes to the people who know the rule, find the form, meet the deadline, and complete the small section that everyone else misses. That is the uncomfortable truth. Now, the form has different names depending on the state and county. In many places, it is called the Senior Homestead Exemption. In other places, it may be called the Senior Property Tax Exemption, Senior Citizens Homestead Exemption, Senior Assessment Freeze, Additional Senior Exemption, Circuit Breaker Credit, or something similar. The names vary, the core idea is usually similar. Your county calculates your property tax based on the assessed value of your home. If your home is assessed at $300,000, the tax system uses that assessed value to calculate what you owe. A senior exemption can reduce the taxable assessed value before the tax is calculated. For example, if your home is assessed at $300,000 and your state or county exempts $50,000 for eligible senior homeowners, then you may be taxed as if the home were assessed at $250,000 instead of $300,000. That difference can lower the bill every year. In some states, the benefit is even more powerful. Instead of simply reducing the assessed value, the program freezes the assessed value. This is often called a senior assessment freeze. A freeze can be extremely valuable in a rising housing market. The year you qualify and file, your taxable value may become locked. If your neighbor's assessed value keeps rising with the market, your taxable value may remain frozen under the program rules. Over 10 years, that difference can become very large. The house next door keeps getting more expensive on paper, the tax bill next door keeps climbing, your taxable value stays locked. That is not a small technicality. That can be the difference between staying in a home and being slowly taxed out of it. This is why senior property tax relief matters. A retiree may have a house that has appreciated significantly over decades but still live on a fixed income. The market value of the house may rise, but the retiree's monthly income may not rise at the same pace. Property tax bills can keep increasing even though cash flow does not. That creates a painful contradiction. The person looks wealthy on paper because the home value rose, but the person may feel cash poor in reality because retirement income is fixed and bills keep rising. That is why these exemptions exist. They are designed to reduce the pressure on older homeowners who may otherwise be forced out of homes they already paid for. But the existence of a program does not mean the program reaches the people who need it. That is the central problem. Consider the story of Carol. Carol is 68 years old. She spent 26 years as a public school teacher in Illinois. She bought a home outside Springfield in 2001 for $162,000. By 2024, the home had been assessed at $310,000. Her annual property tax bill had climbed to around $7,400. Carol paid that bill every year on time. Without complaint, she assumed the bill was the bill. She assumed if she qualified for something, someone would tell her. She assumed the county had the information it needed. She assumed that if there were a senior relief program, it would somehow appear on the tax bill. That assumption cost her money. In 2024, a neighbor mentioned the senior assessment freeze. Carol had never heard of it. She went to the county assessor's website and discovered she had been eligible since 2021. 3 years of eligibility, 3 years of overpayment, 3 years without a letter, 3 years without a phone call, 3 years without a reminder. This is not unusual. This is the rule, not the exception. The system does not usually call you and say, you are paying too much. It does not automatically reduce the bill because you turned 65. It does not necessarily flag your property record and tell you to file. It does not mail the exemption to every person who qualifies. In many places, the burden is entirely on the homeowner. You must know the program exists. You must find the correct form. You must file it on time. You must attach the right document. You must avoid filing the wrong program. You must renew if your state requires renewal. If you miss one step, the county may simply deny the application or let another year pass. This is why I say the system rewards awareness, not only eligibility awareness. Now, the dollar amounts vary widely across the country. In some places, the savings may be a few $100s a year. In other places, the savings can be several $1,000s. The source mentions amounts ranging from about $300 to as much as $6,500 per year, depending on state and program. In New Jersey, the Senior Freeze program can produce very significant savings, with a maximum savings figure in the source of $6,500 per year. $500 per year. Over 10 years, that can add up to $65,000 for a retiree. That is not trivia. That can be healthcare, groceries, home repairs, insurance, transportation, family support, or simply the difference between feeling financially trapped and having a margin of safety. In Texas, homeowners age 65 and older receive an additional exemption. The source describes an additional $60,000 exemption that can save eligible seniors roughly $938 per year in school district taxes alone. Over a decade, that can be close to $10,000. In New York, legislation signed in 2026 now allows localities to exempt up to 65% of a home's assessed value. That can be a major change for homeowners in participating localities. In Illinois, the senior assessment freeze can lock assessed value when the owner files and qualifies. In a state where property taxes are a major burden and assessments can rise, that freeze can become more valuable every year. The numbers differ. The principle does not. If you are eligible and you fail to file, the money does not magically come back to you. You may simply keep paying, and the government may keep receiving the overpayment. Now, the retroactive angle is especially important. In some states, if you qualified in prior years and did not know about the exemption, you may be able to file retroactively. The source notes that Texas may allow up to 2 prior tax years and Illinois may allow up to 3. That means this is not always only about future savings. In some cases, it can be about recovering money that may already have been overpaid. For Carol, that mattered. She was eligible starting in 2021 and filed in 2024. That opened a 3-year retroactive window under the source example. The county processed all 3 retroactive applications. This is the part many people never even think to ask. They assume if they missed it, the money is gone forever. Sometimes that is true, but sometimes it is not. And if there is a chance to recover prior overpayments, it is worth investigating immediately. That is why the deadline matters. A retroactive window is still a window. If the window closes, the opportunity may be gone. If the state allows 3 years and you wait too long, 1 year may fall off. Time itself can become a tax. This is why I would not treat this as something to check. Eventually, I would treat it as something to check. Now, let us talk about why 92% of eligible seniors may never file. The first reason is that the program is not automatic. This is the root of the problem. There is no universal national agency that monitors every homeowner, sees when they turn 65, verifies their income, confirms primary residence, checks ownership, and automatically applies the right exemption across thousands of local jurisdictions. Property taxes are local, administration is local, forms are local, deadlines are local, names vary by state, eligibility varies by state, income limits vary, renewal rules vary. This fragmentation creates confusion. Confusion reduces participation. A senior may not know whether to search for a senior exemption, senior freeze, homestead exemption, circuit breaker credit, or property tax relief program. The county website may be difficult to navigate. Forms may be written in legal language. Deadlines may not be prominent. The tax bill may not mention the benefit clearly. The homeowner may assume the county would have told them. That assumption is costly. The second reason is that deadlines are not always obvious. The source mentions several examples. Florida may close the additional senior exemption on the 1st of March. New York City may close its senior program on the 15th of March. Texas may close the 30th of April. Colorado may run as late as the 15th of July. These dates can differ by jurisdiction and year. They may not appear clearly on the property tax bill. They may not be mailed as reminders. If you do not know to search for them, the deadline can pass silently. Then you wait another year. This is one of the most common ways people lose money in government programs. The benefit exists, but the deadline is quiet. The system does not have to deny you loudly. It can simply let time pass. Silence is enough. The third reason is that multiple programs exist side by side. This may be the most dangerous source of confusion. A county may have a standard homestead exemption for all homeowners, a senior homestead exemption, a senior assessment freeze, a circuit breaker credit, a disabled veteran exemption, an additional senior exemption, or other local relief programs. These may all be administered by the same county office but require different forms, different documents, different eligibility rules, and different deadlines. A homeowner can easily file the wrong form. That is not a minor mistake. If a senior files the standard homestead exemption instead of the senior assessment freeze, the county may process the application as submitted. It may not redirect the homeowner. It may not call and say, "You filed the wrong senior form." It may simply deny or apply only the lesser benefit. The person may believe they do not qualify, but they may have qualified for a different program. That is the first trap. The form itself is not enough. The correct form matters. Now, the second trap is the section that gets many applications rejected. Most states or counties with senior property tax relief programs have some kind of income limit for certain benefits. The exact amount varies. The source mentions Illinois at $65,000 per year for the senior assessment freeze, New York City at $58,399, and Florida, its additional senior exemption below $36,000 per year. If a program has an income limit, the application often requires proof of income. This is where many people get rejected. They fill out the form, but they do not attach the prior year tax return, Social Security award letter, or other required income documentation. They assume the county can check. They assume the application will be returned for correction. They assume the missing document is a small issue. It is often not a small issue. One missing document can result in automatic denial, denied, closed, no benefit for another year. This is the kind of small administrative detail that has large financial consequences. It is the difference between eligibility and actual relief. That is why the income section must be treated seriously. If the form asks for household income, you need to know how the county defines household income. Does it include Social Security, pension income, IRA distributions, wages, interest, dividends, rental income, other household members? The rules can vary. Do not guess. Read the county instructions. If the instructions are unclear, call the county assessor's office and ask exactly what documents are required. Get the person's name if possible. Keep a record, then submit everything in one complete package. This is not overkill. This is how you avoid losing another year. Now, a serious person should approach this like a checklist. Step 1, confirm eligibility. Most programs require age 65 or older. Many require that the property be your primary residence. Many require that you own the home. Some require that you have lived there for a certain period. Some include household income limits. Some require renewal each year. Some do not. Do not assume your state's rules match another state. Rules property tax law is local. Your job is to confirm your county's rule. Step 2. Find the correct form through the county assessor's official government website. This matters. Do not start with a third-party website trying to collect your information. Do not pay someone unnecessary fees just to point you to a public form. Search directly for your county name plus senior homestead exemption application and the current year. Also search senior assessment freeze, senior property tax exemption, circuit breaker credit, and property tax relief if your county uses different language. The official site is usually a county assessor, county treasurer, appraisal district, tax office, or government portal. The official form matters because old forms and third-party versions can cause mistakes. Step 3, Identify all senior-related programs, not just the first one you see. This is important. Do not assume the first form is the only form. In many jurisdictions, the senior homestead exemption and senior assessment freeze are separate. A circuit breaker credit may be separate. A tax deferral program may be separate. A local senior exemption may be separate from a state exemption. You may qualify for more than one program, or you may need a specific program rather than a general one. If you are not sure, call the county office and ask what senior property tax relief programs exist in this county and which ones require separate applications. That question can save money. Step 4. Gather documents before you start. Proof of age may be a driver's license, state ID, passport, or birth certificate. Proof of ownership may be a deed, mortgage statement, property tax bill, or recorded document. Proof of residence may be a driver's license, utility bill, voter registration, or other accepted document. Proof of income may be the prior year federal tax return, Social Security award letter, pension statement, 1099's WTOS, or other documents required by the county. The exact documents depend on the program. The mistake is submitting the form before the documents are ready. Incomplete applications are how people lose benefits. Step 5. Find the exact deadline for the current tax year. Do not rely on a general memory. Search your county name plus property tax exemption deadline and the current year. Then verify on the official county site. Deadlines can change. Programs can have different deadlines. Late applications may or may not be accepted. Retroactive applications may have separate rules. Write down the date, put it on a calendar, submit early. Do not wait until the final week if you can avoid it. Step 6. Ask about retroactive filings. This is crucial. Call or search the official county website and ask whether retroactive applications are allowed for prior years. If yes, ask how many years. Ask whether separate applications are required for each year. Ask what proof of income is required for each prior year. Ask whether the refund comes as a credit, check, or adjustment. Do not assume. Ask a prior year claim may be the difference between a small future savings and a meaningful recovery. Step 7. Submit directly to the county office and keep proof. If filing online, save confirmation numbers, screenshots, PDFs, and emails. If filing by mail, consider certified mail. If filing in person, ask for a stamped copy or receipt. If uploading documents, save the upload confirmation. Paper trails matter. If the county says it did not receive something, you need proof. This is not paranoia. It is basic administration. Step 8. Follow up. Do not assume silence means approval. Call after a reasonable period and ask whether the application is complete, whether any documents are missing, and when the decision will be issued. If denied, ask why in writing. If the denial is due to the wrong form or missing documents, ask whether there is an appeal or correction window. The person who follows up has a better chance than the person who waits. Now, I want to explain the deeper principle. Government benefit programs often operate on an application model, not an automatic entitlement model. That means the law may recognize the right, but the individual must activate it. If the individual does not activate it, the benefit may not happen. This is why knowledge creates money. The person who knows the form saves. The person who does not know the form pays. The person who attaches the proof of income gets reviewed. The person who forgets it gets denied. The person who asks about retroactive claims may recover past money. The person who never asks loses it. The difference is not moral worth. The difference is process. And in finance, process often beats intention. Carol intended to pay what she owed. She did. But she did not know what she did not owe. That is the issue. Now, some people may ask whether this is really worth the effort if the savings are only a few $100s. My answer is yes. First, a few $100s per year matters, especially in retirement. Second, the benefit may compound because it applies annually. Third, some programs save far more than a few $100s. Fourth, assessment freezes can prevent future increases, which means the value may grow over time. Fifth, retroactive claims may recover prior years. Sixth, the effort is mostly paperwork, not new investment risk. In investing, people take market risk to earn returns. Here, the potential return is often obtained by filing a form for a benefit already provided under law. There is no stock to pick, no bond to buy, no financial product to purchase, no speculation required. It is administrative alpha. That is what I would call it. A return created by knowing and executing the administrative rules. Most people ignore administrative alpha because it is boring. But boring money is still money. Property tax relief, energy rebates, healthcare subsidies, retirement account tax advantages. employer matches, homestead exemptions, insurance discounts. These are not glamorous, but they can improve cash flow with very little risk. A serious household pays attention to them. Now, we should also be careful. Not every senior will qualify. Some programs have income limits. Some require primary residence. Some have ownership duration rules. Some localities may not adopt the maximum exemption allowed by state law. Some benefits are capped. Some require annual renewal. Some states use different terminology. Some programs reduce assessed value but do not freeze it. Some freeze value but do not reduce the base amount. That is why local verification is essential. A national video can give awareness. Only your county can confirm your exact rule. Do not rely on a general statement as a final answer. Use it as a prompt to investigate. Now, let us look again at why the system does not automatically notify every qualifying senior. From a process standpoint, counties may not have all the required information. They may know the property owner, but not household income. They may not know whether the property is still a primary residence. They may not know all eligibility details. They may not be legally required to notify. They may be underfunded or understaffed. They may assume the taxpayer is responsible for applying. All of that may be administratively true. But the outcome is still that millions of people overpay. Systems do not need to be malicious to produce harmful outcomes. A system can be passive and still cost people money. That is an important distinction. The county may not be intentionally hiding money from Carol, but if no one tells Carol, and the result is that she pays too much for years, the system still benefits from her lack of information. Intent does not change the cash flow. That is why individuals must be proactive. Now, the property tax issue is especially painful because it is tied to homeownership and retirement. A home is supposed to be security. Many people bought homes decades ago with the hope that by retirement the mortgage would be paid or nearly paid, and the home would provide stability. But property taxes can undermine that stability. Even if the mortgage is gone, taxes remain. Insurance remains, maintenance remains, utilities remain. A senior can own the home outright and still struggle with the annual tax bill. This is especially common in areas where home values rose dramatically. The homeowner did not necessarily become more liquid. They simply became more taxed. The house appreciated, the tax bill increased, the income did not. That is a dangerous mismatch. Senior exemptions and freezes are designed to reduce that mismatch. But again, only if filed. Now, the ARP Foundation's volunteer efforts show that this is not a small edge case. If a volunteer program can help recover nearly $10 million in property tax relief over 5 years, that suggests a much larger hidden problem. A volunteer program is not reaching everyone. It is reaching a fraction of the people who need help. That means the total unclaimed relief may be far larger. This is why family members should pay attention too. Many older homeowners are not going to search county websites. They may not know the terms. They may not be comfortable downloading forms, scanning documents, or uploading income proof. They may assume everything is already handled. They may be embarrassed to ask adult children. Neighbors, church groups, senior centers, financial counselors, and community volunteers can help. This is a practical action. If you have a parent, grandparent, neighbor, or older friend who owns a home, ask whether they have filed for senior property tax relief. Do not assume. Ask directly. Ask whether they filed the senior exemption, senior freeze, and any related programs. Ask whether they attached proof of income. Ask whether they checked retroactive eligibility. A 15-minute conversation may save someone thousands of dollars. That is not exaggeration. That is process. Now, there is another trap. Renewal. Some programs renew automatically after approval. Others require annual renewal. Some require renewal only for income-based programs. Some require income verification every year. Some require notification if income changes or if the property is no longer the primary residence. If renewal is required and you miss it, the benefit may stop. So approval is not the end. A good system includes a calendar reminder every year. Tax relief programs should be managed the same way you manage insurance renewals, tax filings, and retirement account contributions. Put the deadline in writing. Keep a folder with all documents. Save copies of prior approvals. Track whether renewal is required. This is not exciting. It is wealth protection. Now let us talk about the wrong form problem more deeply. When several forms have similar names, the risk of error becomes high. A standard homestead exemption may be available to all homeowners. A senior homestead exemption may add additional value for older homeowners. A senior assessment freeze may be separate and may require income proof. A circuit breaker credit may be state-administered and based on income relative to property tax burden. If you file only the standard homestead exemption, you may miss the senior benefit. If you file the senior exemption but not the freeze, you may miss the long-term assessed value protection. If you file the freeze but omit the income proof, you may be denied. If you file the state credit but not the county exemption, you may miss one layer. This is why you should not ask only, "Did I file the exemption?" Ask, "Which exemption did I file?" The names matter, the form numbers matter, the program details matter. If there are multiple senior tax programs, make a list, then check each one. Now consider the rejection process. A denial letter may make a senior believe they do not qualify. That is psychologically powerful. People trust official letters. If the county says denied, many people stop. They do not appeal. They do not ask why. They do not realize the denial may be administrative, not substantive. Denied because wrong form, denied because missing income proof, denied because missing signature, denied because late deadline, denied because document not attached, denied because prior year income statement was not included. These are different from denied because you truly do not qualify. The difference matters. If you receive a denial, do not just accept it emotionally. Read the reason. Call the office. Ask whether the denial was due to missing documentation or wrong form. Ask whether there is a correction period. Ask whether you may refile. Ask whether there is an appeal. This can feel uncomfortable, but it is necessary. Official systems often respond to persistence. Now, let's think about the income threshold. Income limits can be tricky because household income may not equal taxable income. Some programs may count Social Security differently. Some may include pensions. Some may include IRA distributions. Some may require federal adjusted gross income. Others may use a specific state definition. If you guess wrong, you may either fail to apply when you actually qualify or apply without the right documentation and get denied. Again, the solution is local instructions. If the county instructions define household income, follow that definition exactly. If the definition is unclear, ask. If you use a tax preparer, ask them to help identify the correct income documents. If you are helping a parent, gather the prior year tax return, Social Security statement, pension forms, and other income documents before starting. The missing income proof is one of the biggest rejection points. Do not let one missing attachment cost a year of savings. Now, I want to bring this back to Ray Dalio-style thinking. Everything here is cause and effect cause. Property taxes are based on assessed value effect. Rising home values can raise tax bills, cause seniors often have fixed income effect. Rising tax bills can pressure retirees, cause governments create exemptions and freezes. Effect, eligible seniors can reduce taxable value or lock assessments because the programs are not automatic effect. Most eligible seniors never receive the benefit. Cause, forms, deadlines, and income proof create friction effect. Many people who qualify still get rejected cause. Some states allow retroactive claims effect. People who discover the rule may recover prior overpayments. This is the machine. Once you see the machine, the action is obvious. Do not complain about the tax bill without first checking whether the law already gives you a way to reduce it. Now, I am not saying property taxes are bad in every form. Local governments use them to fund schools, services, infrastructure, police, fire departments, and other public needs. Taxes finance community systems. The issue is not whether taxes should exist. The issue is whether eligible seniors are paying more than the law requires because they were never told how to claim relief. Those are different questions. If a law says a senior homeowner qualifies for a reduction, then failing to apply is not civic virtue. It is unnecessary overpayment. You are not cheating the system by filing the form. You are using the system as written. That is an important psychological point. Some seniors feel uncomfortable asking for relief. They may think it is welfare. They may think they are taking something from someone else. But these exemptions are part of the property tax law. They exist because lawmakers recognized a real problem. If you qualify, filing is not asking for a favor. It is claiming what the law allows. Now, let us examine the 10-year effect. A 1-year tax reduction of $900 may not sound life-changing, but over 10 years, that is $9,000. If the savings are $6,500 per year, 10 years is $65,000. If an assessment freeze prevents compounding tax increases, the cumulative savings can be even larger. And for someone on a fixed income, the value is not only the total dollars, it is the annual cash flow relief, one less bill pressure, one more margin of safety, one more ability to pay insurance, utilities, medical costs, or maintenance without using credit cards or dipping into retirement accounts. Cash flow in retirement is everything. A benefit that improves annual cash flow deserves attention. Now, what should the viewer do today? The first action is not to assume if you are 65 or older and own your primary residence. Check if your spouse is 65 or older. Check if your parent or grandparent is 65 or older and owns a home. Check if you were eligible in prior years but never filed. Check retroactive rules. If you already filed one homestead exemption, check whether there is a separate senior freeze or additional senior exemption. If you were denied, check why. If you missed the deadline, put next year's deadline on the calendar now. If you are under 65, save this information for the future or share it with someone who needs it. The action is simple. The value can be large. Now, I want to be very careful about scams because whenever money and government benefits are involved, scammers appear. If you search online for property tax relief, you may find third-party websites, lead forms, or companies that want personal information or fees. Some may be legitimate service providers, some may not. The safest first step is always the official county assessor, tax collector, appraisal district, or government website. Do not give sensitive information to a random website because it says senior tax relief. Do not pay unnecessary fees until you understand whether the form is free through the county. Do not share social security numbers, tax returns, or identity documents unless you are on an official secure government portal or working with a trusted professional. Administrative awareness should not become vulnerability. Use official sources. Now, let's talk about family communication. This topic can be sensitive. Older homeowners may not want to feel like someone is questioning their finances. They may feel proud that they have paid bills without help. They may resist paperwork. They may not want to share income documents. Approach it respectfully. Do not say, "You have been doing this wrong." Say, "I learned there may be a senior property tax exemption or assessment freeze in your county. It might reduce your bill or even allow a retroactive claim. Can we check together?" That framing matters. The goal is not to criticize. The goal is to protect cash flow. Now, the broader lesson extends beyond property taxes. The financial system is full of hidden rules. Some help you, some hurt you. Many are not advertised. The person who studies the rules has an advantage over the person who assumes the system will automatically optimize for them. The system does not optimize for you. You must optimize for yourself. This is true with taxes, retirement accounts, insurance, Social Security claiming, Medicare enrollment, property assessments, loan terms, investment fees, and estate planning. In every area, forms and deadlines matter. The people who pay attention keep more. The people who do not pay attention often pay more. That is not always fair, but it is real. Now, let us connect this to inflation. Inflation has made retirement harder. Groceries cost more, insurance costs more, utilities cost more, medical care costs more, home repairs cost more, property taxes often rise with assessed values. A senior who was comfortable 5 years ago may now feel squeezed. In that environment, reducing a property tax bill is not a small thing. It is a form of inflation defense. If you cannot control food prices, energy prices, insurance premiums, or healthcare costs, you should at least control the costs where the law gives you a tool. The senior exemption is one of those tools. Do not leave it unused. Now consider the psychological pattern in Carol's story. Carol paid on time for decades. That identity made her responsible, but it also made her vulnerable to overpayment. Responsible people sometimes assume the bill is correct because they do not want trouble. They do not want to challenge anything. They do not want to be seen as difficult. They pay and move on. But being responsible does not mean paying more than legally required. Being responsible means understanding the bill. A tax bill is not sacred. It is a calculation. Calculations can be affected by exemptions, freezes, credits, and classifications. If the classification is incomplete because you did not file a form, the bill may be higher than necessary. You are allowed to reduce it through lawful programs. That is not irresponsible, that is prudent. Now, I want to make the rejection trap very concrete. Imagine you are eligible, you are 68. The home is your primary residence, your income is below the threshold. You download the senior assessment freeze form, you fill out your name, address, property index number, age, ownership information, and signature. You submit it before the deadline, but you forget to attach the tax return or Social Security award letter. What happens in many jurisdictions? The office may not call you, it may not put the application on hold, it may not ask for the missing document. It may simply deny. Weeks later, you receive a letter that looks final. You think, "I guess I do not qualify." But the real problem was not eligibility, it was the missing proof. That is the difference between knowing the program and successfully filing the program. The form is not complete until the evidence is attached. This is the most important operational takeaway: proof of income. where required, is not optional. Proof of age is not optional. Proof of ownership is not optional. Proof of residence is not optional. The exact requirements vary, but if the instructions ask for documents, treat them as part of the form. Now, the wrong form trap is just as important. Imagine you search your county website and see a homestead exemption form. You file it. It gets denied because you already have a standard exemption, or it gives only a smaller benefit. You think you are done. But the senior freeze was a separate form. You never filed it. That can cost thousands. This is why you should search broadly and ask directly. The county office may have a list of exemptions. Read the full list. Do not stop at the first form. If you are helping someone, make a table. Program name, eligibility, age, income limit, primary residence requirement, documents required, deadline, renewal rule, retroactive rule, form link, submission method, status. This may sound like too much for one form, but it prevents expensive mistakes. A household that treats this seriously can save real money. Now, let's talk about retroactive filing more concretely. If a state allows retroactive claims, you may need to submit separate applications for each prior year. Each year may require proof that you qualified during that year. If income limits apply, the county may need income documentation for each year. If ownership or residence must be proven, you may need evidence for those years too. Do not assume one current form covers everything. Ask if the retroactive period is 3 years. As in the Illinois example, gather documents for those years. If the retroactive period is 2 years, as in the Texas example from the source, gather those documents. If your state does not allow retroactive claims, at least make sure you capture future years. The sooner you act, the more years you protect. Now, for seniors in states with assessment freezes, timing can be especially important if property values are rising. Filing now may freeze a lower taxable value than waiting. If you delay, the assessed value may rise before you file and the freeze locks a higher number. That means waiting can permanently reduce the value of the freeze. This is not simply 1 year of savings. It can affect the baseline for many future years. That is why the freeze should be investigated immediately when someone becomes eligible. Now, I want to address an important misconception. Some people think property tax exemptions reduce the market value of the home. They do not. They reduce taxable assessed value, or the calculation used for taxes, depending on the program. They do not mean your home is worth less if you sell. They do not reduce the actual market price. They are tax calculation tools. This matters because some homeowners fear that applying might hurt their property value. It generally does not work that way. Again, confirm locally, but the exemption is about taxation, not the market value a buyer would pay. Now, another misconception is that if you have a mortgage, you cannot file. In many cases, homeowners with mortgages can still file. Proof of ownership may include a mortgage statement or deed. The presence of a mortgage does not necessarily disqualify you. The requirement is usually ownership and primary residence, not being mortgage-free. Again, local rules matter, but do not assume a mortgage disqualifies you. Another misconception is that Social Security income automatically makes someone over the income limit. Not necessarily. Some programs count income in specific ways. Some thresholds may include certain income and exclude other portions. Do not self-disqualify without checking the official rule. Self-disqualification is another way people lose money. They say, I probably do not qualify. Probably is not a planned check. Now, the source mentions several states, but this issue exists broadly. Every state and county can be different. Some programs are generous, some are limited, some require annual renewal, some require income proof, some have deferrals instead of exemptions, some allow tax credits, some have circuit breaker programs tied to income and property tax burden. This means there may be more than one way to reduce the burden. A senior exemption may reduce assessed value. A freeze may lock assessed value. A circuit breaker may provide a credit when property tax exceeds a percentage of income. A deferral may allow payment to be delayed until sale or death, though that can create liens and should be studied carefully. These are different tools. The right tool depends on the household. Do not assume one tool is the whole menu. Now, I want to bring this to a broader financial planning principle for retirees. Lowering expenses can be just as powerful as increasing income. If you save $1,000 per year in property taxes, that is like needing less portfolio withdrawal. Under a 4% withdrawal framework, reducing annual expenses by $1,000 is similar to reducing required retirement assets by $25,000. If you save $4,000 per year, that is like reducing the required portfolio by $100,000. That is why recurring expense reductions matter so much in retirement. A lower tax bill improves the whole retirement system. Less withdrawal pressure, less stress, more flexibility, more money available for healthcare repairs and emergencies. This is not just a tax form, it is retirement cash flow management. Now, what if someone does not need the savings file anyway? If eligible, that money can be used for home maintenance, healthcare reserves, gifts to family, charitable giving, or investing. Overpaying taxes voluntarily when the law provides relief is not necessary. If the program exists and you qualify, using it keeps resources inside your household, then you can decide how to use them. Now, there is a social dimension too. If you know about this and someone else does not, share it. Many seniors are not online all day. They are not watching finance videos. They are not reading county notices. They may never hear the phrase senior assessment freeze unless a neighbor, friend, or family member mentions it. Carol learned from a neighbor. That is a powerful detail. A neighbor's casual comment opened the door to years of savings. Information spreads through people, so if you learn this, tell the older homeowners around you, not because every one of them will qualify, because some of them will. Now, I want to close the loop on why the government has no strong incentive to tell everyone. If every eligible senior filed, local tax collections could fall. Counties and local governments rely on property taxes. They fund budgets with them. Even if the law allows exemptions, the government does not necessarily have a strong financial incentive to maximize participation. Administrators may do what the law requires, but that does not mean they aggressively market the benefit. Again, this does not require bad intent. It is an incentive structure. If you do not file, the county collects more. If you file, you keep more. So you must act in your own interest. This is how systems work. Every institution has incentives. Your job is to understand them. Now, let us summarize the core action in one clean sequence. Find your county assessor or tax office website. Search for senior homestead exemption, senior property tax exemption, senior assessment freeze, circuit breaker credit, and senior tax relief. Confirm age, ownership, primary residence, income limit, renewal, and deadline. Download the correct current year form, gather proof of age, ownership, residence, and income if required. Ask whether retroactive applications are allowed, submit early. Keep proof of submission, follow up. If denied, ask why. If approved, calendar renewal. That sequence can save a homeowner money for years. Now, the deeper lesson is larger than property tax. Do not assume the system will notify you when you are entitled to a benefit. Do not assume the first form you find is the correct one. Do not assume missing documents will be corrected automatically. Do not assume a denial means true ineligibility. Do not assume no retroactive claim exists. Do not assume deadlines will be mailed to you. Do not assume an official bill is optimized for your lowest lawful payment. Assumptions are expensive, verification is cheaper. That is the principle. Now, if you are listening and you are a senior homeowner, this is not something to be ashamed of. If you have overpaid, it does not mean you were foolish. It means the system was not designed to make the relief obvious. You did what millions of responsible people did. You paid the bill you received. Now you know to check. That is all. If you are helping a senior homeowner, be patient. The paperwork can be confusing. The names can be frustrating. The deadlines can be scattered. The income documentation can feel invasive, but the savings may be meaningful enough to justify the effort. A small administrative action can change annual cash flow. That is worth doing. Now, I would frame the final principle this way. In a world where inflation is high, healthcare is expensive, insurance is rising, and retirement income is limited, you cannot afford to ignore lawful expense reductions. A property tax exemption may not make you rich, but it can keep money from leaving unnecessarily, and wealth is not only built by earning more, it is also built by not losing what the law allows you to keep. The average senior homeowner may be paying thousands in property taxes. Millions may qualify for reductions. Only a small share apply. Many who apply may still lose because of wrong forms, missed deadlines, or missing proof of income. That is the trap. The way out is not complicated, but it requires action. Know the program, find the correct form, attach the right documents, meet the deadline, ask about retroactive relief, follow up. That is the process. Carol lost years because no one told her, but once she knew, she acted. That is the lesson. The government may not knock on your door to tell you that you are overpaying. The county may not correct your form. The deadline may not appear on your bill. The missing document may not be requested. The wrong form may not be redirected. So you must become your own advocate. That is how you protect your money inside a system that often rewards the people who know the paperwork better than the people who simply qualify. If you are eligible, this is not a loophole. It is not a trick. It is not a favor. It is a benefit written into law. And if one form can reduce a bill you have been paying for years, then the most expensive thing you can do is assume someone else would have told you.